Perfect. So if everyone just wants to view the screen there, you should be able to see the presentation. Got a few late joiners here. Perfect. Good evening, everyone. All right, folks. Welcome back for another Fireside Chat with Soli. Thanks, everyone, for joining us. This week, I've taken some feedback on board from some of the moderators. We'll be keeping these sessions a little bit more condensed than their predecessors. It seems as though I've kind of forgotten that, people are time poor and don't necessarily have an hour to sit here and listen to me rant and waffle. So as such, I'll be doing my best to condense this information and, shorten the duration to half an hour in order to keep everyone's attention spans. That said, for any DAO or proposal related issues, we'll let these run as long as they must in order for the community to have all of the information necessary. But for the learning series such as this one, I'll be aiming to keep these, as condensed as possible moving forward. So waffle out of the way, let's push on with this week's topic, the due diligence process and why fundamental analysis is important when, picking which projects to do. So look, before we tuck into best practice due diligence, I want to acknowledge that there were a number of requests from the community, for me to cover a specific topic, in relation to leverage trading and leverage trading techniques. While I'd actually love to cover this one, our legal team have cautioned us to err on the side of caution. Educational series and steer away from anything too technical that could be deemed financial advice. With leverage techniques, there's dozens of techniques that can be deployed in various market conditions. However, nobody really has a crystal ball, and I'd hate for people to lose money on one of these techniques or, lose or worse, try to go me for using a technique that I spoke of. All it really takes is a squeeze wick to wreck someone, and then poof, your money's gone. And I'd hate for someone, to face that reality as a result of something I've presented. As I'm looking at the ETH chart right now, the market is clearly insanely irrational in comparison to the macro outlook at the moment. And as I'm not a registered financial advisor, I won't be able to oblige that subject matter. I'm sorry. Right, with that explanation out of the way, I'll push on with this week's, what was the next most requested topic, the process of conducting due diligence, why fundamental analysis is important. So it seems, as people are prepping their techniques and sharpening the knives, so to speak, for the next bull cycle, and maybe want some revision on various processes for conducting due diligence, which I heavily advocate. So let's break this down a little bit. What is due diligence and fundamental analysis? So first off, whether you're dealing with century-old stocks or nascent cryptocurrencies, there's no exact science involved. If there was Wall Street's top players, ensure that this formula is remains a well-kept secret. So if this said, what we have instead is a vast array of tools and methodologies that investors employ in order to give them the edge over the house, so to speak. So for the most part, you can sort these techniques into two categories: fundamental analysis and technical analysis. In my opinion, by combining both of these processes and these methodologies together, investors hope, to avoid being scammed and hope to be able to identify Ponzi-nomics and pick investments that, have sound logic to their product offering and identifying solutions offered by the products underneath these investments that are likely to give a company or a protocol the edge, thus giving the investor the best chance to make a good return on their investment. So for the sake of keeping this presentation, detailed, but at the same time, or keeping within the new time frame protocol that the mods have set me, we'll be focusing on fundamental analysis specifically for this particular segment. So let's dive in. So what is fundamental analysis? So fundamental analysis was first emerged in 1934, I think it was, with the publication of Security Analysis, which was a book about investing at the time. Its processes were widely adopted by the public and have evolved along with the evolution of market types and styles of investing. It's a method used by investors and traders which aims to draw out and identify the intrinsic value of assets or businesses. So metrics between layer 1 and layer 3 protocols also vary. As mentioned previously, metrics between TradFi and crypto vary, which is why processes must be adapted. But this variation also applies to layer 1 and layer 3 protocols. So what I'm saying here is the processes that you use to assess under fundamental analysis for layer 1s may not necessarily apply to layer 3s. So firstly, before we specifically look at processes of fundamental analysis for these, let's quickly define and separate them. So a layer 1 protocol is a blockchain in itself. It is a network that hosts and supports an ecosystem within itself. Examples of these, include AVAX, Binance Smart Chain, Ethereum, and of course, Phantom. A layer 3 protocol is essentially an ecosystem that exists by the support of a layer 1, commonly referred to as dApps. SpiritSwap is an example of a layer 3 protocol built on top of Phantom, by virtue of its network support. So without the layer 1 there to host the application, SpiritSwap wouldn't have the infrastructure to exist. So let's have a look at fundamental analysis specifically pertaining to layer 1s. Due to metric differences between layer 1s and layer 3s, different assessment metrics need to be employed. There are, some of the more common metrics, investigated by would-be investors in layer 1s, can be boiled down to the following. So on-chain metrics. On-chain metrics are those that can be observed by looking at data provided by the blockchain. We could do this ourselves by, for example, running a node in order to acquire the required data. However, this can be quite time-consuming and expensive. A more straightforward solution would be to pull the information from websites or, APIs specifically designed for the purpose of informing investment decisions. For example, CoinMarketCap, is one of these that does this well in their on-chain analysis metrics. Transaction count, that gives us an indication or a good indication of the layer 1 network's health by measuring the level of activity taking place on the network. By plotting the number of for set periods or by using moving averages, we can see how this activity changes over time. It should be noted that, these metrics should be taken with a pinch of salt, as these figures can be inflated, which we'll explore in the next the next drawdown of this list. That being active addresses. So active addresses are, the addresses on the blockchain, the blockchain's addresses that are active in a given period, and a common metric to determine a measure of growth. Approaches for calculating this can vary. A popular method is to count both the sender and receiver addresses of each transaction over set periods of time. For example, days, weeks, or months. Some others also, examine the number of unique addresses cumulatively, meaning that, they track the total over time. As mentioned above, this must be taken with a pinch of salt, as these figures can easily be inflated, albeit not intentionally. However, one can't be sure that, say, for example, there isn't just one party transferring funds between their own wallets for various purposes. It's not uncommon for people to have several wallets. So, this must be taken into consideration when assessing this metric. The transaction value, so this is quite commonly confused, but not to be confused with the transaction count. Rather, the transaction value or transaction volume tells us how much value has been transacted within a period. For example, if a total of, let's say, 100 Phantom transactions worth $1,000 each were sent on a set day, we would say that the daily transaction value was $100,000. Growth of this metric over time would suggest that the value of capital flowing on chain is, experiencing growth and adoption. Volume and fees, or fees paid, or gas prices. This is often the most overlooked metric, in my opinion, but one of the most important. Essentially, this metric gives us insight into the demand for block space. One could consider, this metric as a metric of bids at an auction house. Let's say, just like an auction house in layer one chains, users of the chain will essentially compete with each other. Again, just like people bidding on a piece of art, to have their transactions included in a timely manner. Especially if there is a thriving DeFi atmosphere. So those bidding higher gas prices will have their transactions confirmed far quicker. This is a good indicator that not only validation or miners are receiving healthy incentives for supporting the chain, but it's also a good indicator that the applications supported by this layer one are also thriving. Now, the NVT, or network value to transactions ratio, is another interesting one. The NVT essentially tries to interpret a specific network's value based on the value of transactions it processes. This is based on a formula of network value divided by the daily transaction volume. So, for example, let's say you're comparing two different protocols. So we'll call them Coin 1 and Coin 2 in this example. Both have a market capitalization of 10 million. However, Coin 1 has a daily transaction volume worth $1 million, whereas Coin 2 has a daily transaction value worth 250K. So, using the formula, the NVT ratio for Coin 1 is 10, and the NVT ratio for Coin 2 is 40. So generally speaking, assets with lower NVT ratios are considered undervalued, while those with higher ratios may be considered overvalued. These merits alone, suggest that Coin 1 is undervalued in comparison with Coin 2 in this case. Just want to note here that everything I've mentioned above, these aren't all of the fundamental analysis strategies that you can deploy. However, they are the main ones. So for the remaining fundamentals that apply to layer 3s, these can also be applied to layer 1 metrics as well. However, given that there's an overlap here, we will continue with these on the next slide, which pertains to layer 3 fundamental analysis specifically. So as I mentioned, not all metrics are pertinent to layer 3s as they are to layer 1s. Some can be converted in principle. So, for example, active wallets could be converted to, the layer 3 protocol's tokens held within wallets. However, some of these are moot point. So this slide specifically covers fundamental analysis validation metrics that are pertinent to layer 3s. However, the same metrics absolutely overlap with layer 1s as well. So, these can and should be applied to layer 1 fundamental analysis as well. So roadmap, white paper, and team. One of the most popular and common ports of call when conducting due diligence as a part of your fundamental analysis involves some good old-fashioned research into the project. Reading white paper will give you insight into understanding the project's goals, the token's use cases, the various revenue streams, along with the underlying technology. Although DeFi predominantly runs on an anonymous pretext, if identified, the track records of the team members can give you an idea of their ability to build and scale the project. And, obviously, lastly, the roadmap tells you the direction, of the protocol, how they plan to scale it further, stay competitive, and, continue to achieve a new revenue stream for investors moving forward. Tokenomics and initial distribution. Some of the projects, they can create tokens as a solution, or rather looking for a problem. So this is an important factor to rule out. Understanding the tokenomic model essentially allows you to identify your potential to earn from the token. What's its revenue metrics? This will basically give you an indication of a passive profitability forecast. Furthermore, taking a deep dive into the distribution model might unearth, any risks that might exist. So, for instance, if the vast majority of the supply was owned by a few parties, let's say, we might come to the conclusion or reach the conclusion that this is a risky investment because those parties could eventually essentially manipulate the market. Market capitalization. This is an interesting one. So examining the MC can be useful, can be a useful tool. It is also a double-edged sword. I don't particularly like this one too much. Market capitalization is essentially or sometimes used to gauge the growth of, or the growth potential, I should say, of a protocol in question. So some crypto investors, they view small cap coins as offering more growth potential compared to large cap ones. Well, others go by the premise that large caps have stronger network effects, thus offer a better chance than less battle tested smaller caps. It's pertinent to note, be aware, by itself, market capitalization can be misleading. One example being that any protocol could really, spin up a useless token with a supply of 10 million. And if just one of those tokens were traded for $1, then the market cap would hit an inflated value of $10 million. This valuation is quite obviously manipulated. And considering the scenario without a value proposition that offers strength, it's unlikely that the wider market would be interested in purchasing this token, and you could basically be left bag-holding garbage, so to speak. So the market cap metric should also be taken with a pinch of salt and applied with caution in conjunction with other metrics surrounding fundamental analysis. Volume and liquidity. So essentially, this is a measure of how liquid an asset is. This will indicate how easily a token can be purchased or sold, and what slippage you might incur doing so. Issues that can be encountered, I guess, with illiquid markets, is that investors aren't able to sell their assets at a fair price or true market rate. As the slippage on large spreads means that unrealized profit and loss is simply fiction, covered up under the guise of a phony market cap. So assessing spreads, which is the difference between the asks and the bids, is a good indicator of how liquid a market may be. So now that we've looked at some of the common assessment metrics for executing fundamental analysis, let's take a look at the pros and cons before some concluding comments. Look, with all fireside topics, I like to try and be as objective as possible and examine the validity of all topics discussed. As such, I've taken the liberty of compiling some quick pros and cons to consider here. So let's first off take a look at some of the pros. Fundamental analysis, it assesses the viability of potential profitability in a manner that, any format of technical analysis can't. This said, and although it's not covered in this particular fireside, technical analysis also does have its strengths, absolutely. When applied in conjunction with each other, so technical analysis and fundamental analysis, that is, both offer profound insight into the potential profit of an investment. The next pro is anyone can really do fundamental analysis. You just have to make sure to have a metric assessment plan, ensuring that you're combining the correct mix of assessment metrics and the ability to read between the lines, see through the bullshit, so to speak. This is due to the fact that to be done well, it only really relies on tried and true techniques, so long as you have access to the qualitative data. If this data, is not readily available, then, to me, this is often a big red flag that would likely validate, you looking for another investment or investment options. If done correctly, fundamental analysis provides profound insight into the growth prospects of a potential investment. You just have to look at what the big players do time and time again. Top investors like Benjamin Graham, for example, or Warren Buffett, and firms like Vanguard and BlackRock. They've been consistent in exemplifying that rigorous research into businesses and potential investments, using such methods can yield tremendous success when making investment-based decisions. Some good old market manipulation hasn't hurt them either. The pros are moving on to the cons, and some things to be mindful of. Fundamental analysis is easy, but good fundamental analysis actually requires time and dedication. I kind of feel like the inherent impatience of the crypto market often sees this as a barrier of entry, which is a shame. That everyone just sort of wanting to ape and catch the next wave before everyone else does, climbing the Ponzi ladder, so to speak. Many factors need to be addressed, and the learning curve for doing so, can be extremely steep. Just don't expect to get it all right at once, I guess is what I'm trying to say here. Learn as you go and recognize that you are, in fact, you're on a learning journey, as we all are. Obviously don't invest more than you can afford to lose until you start, honing your fundamental analysis techniques. And make sure to learn from any mistakes and apply these learnings to your models and methodologies moving forward. Fundamental analysis is sort of better suited to long-term trades, rather than short-term ones. That's quite simply because it applies metrics that generally require time to mature or come to fruition. For example, tokenomic metrics is, they gear up over time. Bonding curves, are possibly a good example of this. And lastly, nothing is a given. There are no crystal balls, and don't take everything for granted. Investments that may appear undervalued, by every metric are not guaranteed to deliver any future growth. So with that, I'll leave you with a quote from the 1930s economist, one of my favorite economists, John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. And personally, I think we're seeing that in the crypto market right now. Given the CPI print yesterday, huge volatility dump, and then now we're above where we opened a couple of days prior. So, with the presentation coming to an end, I just want to give my closing thoughts and I guess reiterate on what we covered today. Fundamental analysis is a powerful tool that can empower users to see beyond the apes. However, as Keynes poignantly reminds us, markets can be irrational from both a bull and bear perspective. And this should always be taken into consideration, in my opinion. Take all the time you need to consider the metrics on offer and study them rigorously. Robust fundamental analysis strategies are comprised of many different components. So I guess leave no stone unturned if you have the time to do so, I guess is what I'm saying here. Obviously, look, applying a combination of technical analysis and fundamental analysis is recommended. I advocate this heavily. Technical analysis will, often identify factors that fundamental analysis misses, qualitative versus quantitative, I guess, in a sense, and vice versa. This approach may take more time, but it could also, save or make you a lot more money as well. And remember, fundamental analysis, it's an art, in that it's perfected over time. We've barely scratched the surface on things today, but I guess, look, my goal of this presentation or discussion is to, bring this vastly overlooked and underutilized topic to light, and hope that, once the bull market resumes and the apes start aping again, all of you will consider these tools of thought and research in your future investment strategies. Not only to yield more profitability, but to also protect your capital. Look, thank you for your time. I think we kept that under half an hour, which is probably a record for me. I hope, I've managed to impart some value this evening. Ege, we can take Q&A now if any of the community members want to ask any questions relating to this presentation or SpiritSwap in general. Let's get them up on stage.
Thank you for your good presentation, brother, as always.
You're most welcome, my friend.
If you guys got any questions, please let us know, so our DJ can answer you right away.
I guess while we're waiting for any questions, I've been testing V2 today. And man, I don't think I've been so excited. It's I guess I don't often talk about V2 because it's all under lock and key, but like we're so close now. Kind of ironing out some last minute bugs. We made huge progress today on. I don't really know if Sid will allow me to say it, but some back code optimization essentially. The site is just super quick, like just instantaneous load now. This has also fixed a whole lot of, I guess, other bugs that we've kind of been working on. You know, as you make things, you break them. But this has kind of sped that process up. The guys have also implemented a whole bunch of other features that, you know, weren't too hard to implement, but they're really, really cool. I guess, you know, one example of one that I just tested out now is when you add liquidity now, and I mean, this is super basic, but it's just really cool for user experience. You know, when you add liquidity, you can actually zap straight to a farm now. You know, so you don't have to sort of constantly add extra clicks, I suppose. You know, we've got some really, really cool, how do I put it? Indication options. So, you know, once I guess this really pertains to new users, but it's also super good user experience for existing users as well. Once you take in or make an action in V2, what we'll actually do is it'll kind of recommend next steps for you. So, okay, you've just done this, now you can do that or this, you know. Say, for example, when you claim your weekly distribution, it gives you the option straight away as the transaction confirms. The pop-up will kind of pop up and say, you know, would you like to relock this, or would you like to put it into a liquidity pool? Would you like to swap it? So, yeah, just really cool, I guess, you know, little bits of additional user experience that I feel will kind of set us aside from the competition. These are just really sort of basic high level ones that I'm talking about now, but you know, once you guys are able to tuck in and you know, get into the nitty gritty of it, I think you guys are going to be excited. I think I've spent most of the afternoon just raving to Rob about how amazing you know, these updates are now that they've been pushed to staging, you know, and merged and accepted and peer reviewed by the team. So yeah, it's looking pretty damn fly. Doesn't look like we have any questions from the community. Next week, I think we're going to have Professor Heesh coming back. And I believe he's going to hit us with a topic all about bonding curve models, which is super interesting. Kind of pertinent to something we have coming up as well. Those who are able to sort of read between the lines from a technical perspective might get a little bit of alpha here. So I'd highly recommend those that are listening today, you know, pop into that chat with us. I know everybody loves Heesh. You know, they love how super technical he gets, and on his little remarkable pad that he has. So yeah, anyone looking forward to that, you know, make sure to join us next week. Ege, sorry, you were saying something.
Yeah, Nick. Dan, I can ask you a question.
Absolutely.
Then, could you give us a bit detail about SpiritSwap transition to DAO, and where are we at, and when we can expect the full transition after version 2, or and how the system is going?
So
right go on SpiritSwap.
Yeah, so right now the only we operate, you know, under a DAO premise. You know, we're the kind of hold up there is launching V2. We want to sort of launch V2 and transition to a DAO at the same time. The reason being is because there are some key sort of how do I put it, decisions that need to be made while we're developing V2, that if we were a DAO at the time, it would require I guess, you know, vast amounts of proposals being made in order to get the data to accept these. So once V2 is, you know, all done and dusted, we can then expect to, you know, have full DAO transition and then turn our eyes towards on-chain governance, which I'm even more excited about. You know, as I sort of chatted about in my governance presentation a couple of weeks back, you know, our goals are kind of, for our secret source, I suppose, are to sort of combine metrics of DAOs and on-chain governance in one. So essentially, having no governance, I suppose, which is the ultimate goal. Everything being done on chain, permissionlessly. That's kind of where we aim to sort of take things very quickly after the transition, full transition to the DAO. So hope that answers your question.
Yep. I mean, I already know, but just wanted to ask for the community.
Yeah.
On the meantime, guys, if you got any questions, please let us know. Otherwise, I think DJ and Told really gives us good product, I can say.
Yeah. Sure. Well, look, if all right. Well, look, if there's no further questions, then I'll get back to testing V2 so I can make some tickets and tidy things up, as soon as possible for you guys and get this beast launched. But yeah, as you sort of stare at something all day, every day, it's like a long drawn sigh. But I guess, today was kind of the day that I actually really started getting excited, seeing a lot of these commits merged and, these PRs enacted. So,
Hype train.
I try not to, but today I am feeling a little bit hype trained. Yeah, definitely. Awesome. Well, look, guys, thank you so much for joining us today. Make sure to, if you're watching this on YouTube, like, subscribe, and share. And I'll catch you guys on the next one.